Good morning, everybody. Very warm welcome. I wish it was a warm welcome. The weather here in England is absolutely dreadful. But a warm welcome from Lawrence and myself. Welcome to this webinar, UK Property Tax Planning for Foreign Investors, a Challenging Landscape. We've got way over 100 people attending, so and more people are coming into the room, so thank you for doing this early on in English European time. And I think as the clocks went, the clocks changed the weekend. Good afternoon, Middle East and Asia and everybody else, perhaps. Welcome again.
Good evening from Singapore.
Good. Lawrence joins us from Singapore, where it's not raining, and welcome, Lawrence. There is Lawrence Lancaster and myself delivering this webinar today. We did a similar one in September last year, and 14 months later, we're updating you for those that attended last one. And this is a sort of a yearly event. So I'm telling Lawrence, if he possibly can, to make sure the next one being a live in attendance event next year in 2023 in London to look forward to. But we'll carry on with the webinars in this new way of working. So very warm welcome to you all. That's what we're going to cover, and the what we're going to focus in today's webinar. There's 5 parts, and if any of you wanted to ask questions, do so in the question bar on your screen, because we'd like to take questions as we canter through each part. There's 5 parts, ladies and gentlemen. Part 1, trust planning, buying property for personal use. Part 2 goes into UK property investment, your typical buy-to-let investment opportunities using UK, non-UK, and even family investment companies. We then steer into part 3, which is using international pension schemes for UK property investments, and these can be used by both UK domiciled and non-UK domiciled, even UK residents and non-UK residents. Part 4, a favourite of mine, a little less problematic or less challenging to buy and invest in UK commercial property, including wrapper planning with pensions and trusts. And then this year we've got a new part 5, which recently introduced legislation, new registers that apply to overseas structures holding UK property. That's the Register of Overseas Entities, obviously applicable to overseas entities, and the Trust Registration Service, which Sovereign delivers. But we just need to bring your attention to these 2 new standards. Again, please ask questions along the way. The presentation's being recorded, so we can send you a web link with this presentation to have saved on your desktop as a reference guide. But at least that tells everybody in the audience, way over 100 now, so thank you for coming in and so promptly. So with that introduction, I will now move to introduce my colleague, Lawrence Lancaster, who will officially start part 1. Lawrence, good morning or good afternoon in Singapore.
Thank you very much, Simon. So we're going to start off with just a quick run through these new penal stamp duty land tax charges. We're not going to give any sort of detail on stamp duty day today. The purpose of running you through this quickly now is that later on we've got some solutions using interest in possession trusts, which can plan around potentially these 2 charges. So to start off with then, all companies and discretionary trusts are subject to this new 3% or relatively new 3% surcharge. It's been with us for a few years now, even if they don't hold any other property. So obviously with individuals, if you don't hold a property anywhere else in the world, in the UK or in the world, then you're not subject to this 3% charge. But with companies and discretionary trusts, they're just subject to it anyway. That condition does not apply, that you need to own another property, so quite harsh there. The 2% surcharge, this is a new one, and it's effectively discriminatory against people such as myself who live not in the UK, It's only non-UK residents who are subject to this 2% charge. They actually have a special test for determining residents for this 2% charge. And no surprises, it's more difficult to be UK resident to benefit from not being subject to this 2% charge. So you'll actually find some people are UK resident under general law, but are not UK resident for the purposes of this 2% charge, so will still be clobbered with it. And the third charge, the 15% charge that potentially can apply to companies, UK companies or non-UK companies, which purchase property for more than $500,000. When a company does purchase such a property, it has to be let out to a third party for at least 3 years to avoid that charge. And HMRC do police this quite heavily. So it is something to watch. And another point on this is that if it's an overseas company and it is subject to this 15% charge, the company would not be subject to the 3% charge, but it would be subject to the 2% charge, which effectively means that it would be subject to a flat rate of stamp duty land tax of 17% if it was purchasing a property, residential, of course. These 2% and 3% only apply to residential property, but it would be subject to a flat rate of stamp duty of 17%. The slight softening of the stamp duty tapering rate, the standard stamp duty that was introduced earlier this year in September, that very small bit of relief does extend to non-residents and to companies and trusts, but we're not going to be providing any planning in respect of that part of stamp duty tax today. So we really just want to be focusing at this stage on these two charges. So we can now go into our first illustration, I think.
Yes, that's right. There are eight of these today, Lawrence. Yeah.
Yeah, absolutely. So the first one, we're going to be referring to this concept a lot today, and we did refer to it last year as well, this flexible property trust concept. Well, what does that mean? What it means is that you've got, effectively, you set up a trust that starts off its life as an excluded property trust, and there are two conditions which need to be met for an EPT, excluded property trust. The first is that the settler has to be non-UK domiciled and not deemed domiciled. And the second is that overseas assets have to be settled into that trust. So the flexible property trusts will always start their life off as an EPT, but what then happens is they invest in UK property directly, and what that means is they're no longer an EPT. They become a relevant property trust. But what we do is we structure the trust in such a way, while it is an EPT, to ensure that it's most efficient for UK tax purposes before you take the plunge and invest in UK property. So with this first one, it's called a carve-out trust, and it's designed for settlors, again, who are non-UK domiciled, who want to use the property that they're investing in. The minimum purchase cost for this is going to be 2 million, but it's normally, when we do these, they're more than 2 million. I think if it's 2 million or less, you're just best off buying in your own name. But you may find that clients have other UK assets, non-doms have other UK chargeable assets, which is going to be UK property, that are eating all of their nil rate band up and the double nil rate band, whatever. So effectively, in that instance, it may be that they want to use this, even though they're only buying a property for 2 million. The key is it's a non-domiciled settler, as I've said, overseas funds go in. It's a carve-out trust. So what that means is that under the terms of the trust deed, the settler has the right to use the property or receive the income from it, but he is excluded or she is excluded as a capital beneficiary. The beneficiaries will be, the capital beneficiaries can be the settler's spouse and more typically the children. And all of these beneficiaries have the right to use the property under the terms of the trust deed, but the settler is excluded as a capital beneficiary, and that is key, and that ensures that it falls within this carve-out principle. So just running through then the tax charges that apply if you're using this planning. SDLT, well, there's nothing in this instance you can do about the 3% and the 2% charges. The reason for that is that our settler is non-UK domiciled, and he has, in this example, other property around the world, So we're going to get that 3% charge. Settler is non-resident, so you're going to get the 2% charge, and on top of which you're going to get the standard stamp duty. There's no lifetime inheritance tax because when the settlement was made, the settler was non-dom and overseas assets were settled into the trust. There's no annual tax on envelope dwellings because the trust is not a company. We sometimes get this question, well, actually, isn't it a corporate trustee that owns the property legally? And yes, it is. Fortunately, the legislation makes quite clear that if it's a company that's acting as a trustee, then it's excluded from the scope of ATED. There is capital gains tax when the trustee comes to sell the property, but because you can see there's a range of beneficiaries, often with this trust, what you can do is ensure that there's always a beneficiary using it as their main residence. And that means that you'll either get full main residence relief or partial main residence relief. You'll get partial relief if it hasn't been used by a beneficiary throughout the period of ownership as their main residence. But the good thing is with this type of trust is that there's multiple beneficiaries, each of whom can use it as a main residence, and therefore the trust qualifies through each one of those. So that's a big advantage over individual ownership. There shouldn't be IHT on the settler's death because of the carve-out principle, and there's House of Lords authority for that. The Ingram case tells us that carve-outs are effective for the purposes of the reservation of benefit rules. So despite the fact that the settler has use of the asset, he has carved out the right to use before he has effectively made the gift into the trust. There's no IHT on the death of beneficiaries, and as I said at the start of this slide, if the UK property is sold and the proceeds are deposited off overseas, then it reverts back to being an excluded property trust. And we're going to see that a lot, that with this flexible property principle, you can move in and out of the relevant property and excluded property regimes. Back in 2017, the government were going to introduce an exit charge when you moved from relevant property to excluded property, but there was a lot of pressure put on them and they removed that. So we're quite happy that that still remains the case, and that's a statutory provision for that. So that works quite well. You do finally get the 10-year charge, which I didn't mention. Every 10 years, obviously. Some planning there is to use mortgage finance, and then effectively the 10-year charge is imposed on the net value, so the property minus the mortgage. But it is very important that the mortgage is taken out at the time of purchase, not subsequently, or else it's unlikely to work. The other thing you can do is to sell the property shortly before the anniversary and deposit the proceeds off overseas, and again that's fine as well. There's no lag period. You could sell the trustee could sell the property 2 months before the 10-year anniversary, and that would still ensure that there was no 10-year charge. As we're going through this, as ever, feel free to ask questions, but that's all I've got to say on this slide, so it's over to you now, Simon.
Thank you, Lawrence. And what Lawrence has delivered there in his illustration 1 sort of sets the scene for the other, or the rest of the illustrations. We're moving on to illustration 2 now, ladies and gentlemen, and the applicability here is non-UK domiciled persons. Again, the asset is lifestyle for personal use, and the objective is for property enjoyment by the family, and to protect the settlor and the family from the draconian inheritance tax charges, the worst on the planet. So in this case, and I always try to explain, there's 4 main elements to this planning and to conventional trust planning. It starts with the non-UK domiciled settlor that contributes the purchase cost or the deposit if there's mortgage finance, and trustees tend to, if they're worth the weight in gold, which we are one, of course, they should be able to position the client trust to obtain about a 50% loan to purchase finance, and we have organisations and institutions that do deliver that level of finance. You may struggle to get a bit more, although the finance is useful for the 10-yearly anniversary charge planning. So the purchase price or cost, purchase price plus costs, is settled into the trust. The settlor appoints sovereign trust as the overseas trustees. That's element 2. The beneficiaries important in this example, ladies and gentlemen, that the beneficiaries in this example are the spouse, the children, other loved ones, even third parties. But specifically, the settlor is excluded, and the fourth item to this is that the asset is the property, the most important thing to the settlor and beneficiaries, which they're going to enjoy, and that sets out why this illustration is slightly more different to the one that Lawrence canted us through before. But the benefits, ladies and gentlemen, well, we start with not a benefit, but SDLT, the surcharges do apply, but quickly on, no lifetime inheritance tax with regard to the deposit or the purchase price going in. Certainly no ATED, that's annual tax on envelope dwellings, because the trust's not a company. Please don't buy property through companies for properties that are going to be enjoyed by the shareholders, directors, and closely connected parties. No capital gains tax as main residence relief can be claimed, as Lawrence mentioned earlier. No inheritance tax on the settlor's demise, and we're delivering on the tax advice on each of these situations, independent of sovereign, of course. No inheritance tax, UK inheritance tax on demise of other beneficiaries, and excluded property trust status reverts if the property is eventually sold. For the 10-yearly anniversary charges, that can be mitigated by mortgage finance, which is why I mentioned that in illustration and case study number 2. And there's quite a few case studies to go through, so I'll quickly hand over to my colleague who will, having set the scene, will canter you a little more quickly through this one.
Sure. So earlier on I mentioned the 2% and 3% charges, and in the original example of the carve-out trust, those two charges were in point. This is quite a typical situation that you find where you've got a non-domiciled overseas client, non-UK resident, whose children have been educated or in the process of being educated in the UK, and then they remain in the UK to work, typically in London. So in this instance, the parent will often fund a purchase or of a property for that child, or they'll provide them with the deposit or whatever to go and buy it. Often a concern, though, is that they don't want the child to own the property outright because of asset protection reasons. So the good thing about these two charges, the 2% and 3% charges, where you have an interest in possession trust, it's seen through to the beneficiary. So the beneficiary is treated as though they're buying the property, which opens up the door for some planning. So in this instance, we've got our non-dom settler. He's going to purchase a property. Let's say it's in London for 2 million. What he does is set up an interest in possession trust. In this instance, it's Isle of Man. It could be a UK interest in possession trust. We can offer both. And obviously, we could do this in Guernsey as well. So 2 million goes in as a settlement. That's excluded property at this stage because non-dom overseas cash. The child, who is over 18, is the life tenant. And as a result, they're treated as owning the property. You have other beneficiaries of the settlor who are also beneficiaries, but they're discretionary beneficiaries. And the trustee purchases the property. What's the SDLT position here? Well, because of the see-through provision, the child is the one who's treated as buying the property. Now, they're over 18, and there's no provision that actually treats the settlor as the person who's buying the property. So there's no 2% SDLT surcharge because the child is UK resident. There's no 3% charge because the child doesn't hold any other property. The child is then going to use the property as their main residence. So again, we get principal private residence relief. There's no inheritance tax. We don't need to bother with the carve-out planning here because the settler's not going to use the property, so we just exclude them. Very easy. And then, well, what's the tax saving? Well, had the settlor purchased the property in their own right, then there would have been £100,000 more stamp duty to pay compared to using this. And you may say, well, the child could have just bought it and the tax treatment, the SDLT treatment would have been the same. That is true. If the child bought it, though, you would then obviously the asset would fall within their estate for IHT. But I think more where this is popular is for asset protection reasons, because parents don't want the child to actually just have all of that property in their free estate at such a young age. Again, one final point, we do have the 10-year charge with this. Again, you can mitigate that with mortgage or by selling the property shortly before the 10-year anniversary. So that's, I think, deals with all the points there.
You've got that stamp duty saving of 100,000, Lawrence, as well, haven't we? If you haven't mentioned that.
Yeah, that's right, 100,000. So just to be clear, the £100,000 saving applies in this instance where the purchase cost is 2 million. So we settled 2 million into the trust. The settler paid for all the expenses, including the stamp duty tax. And there was a saving of £100,000 compared to a direct purchase by the settlor.
Correct. Very good. Now we've gone through part 1 with 3 illustrations. We're now into part 2, Lawrence. UK company versus overseas company, a choice. You're starting us off on this one.
Yeah, I'm just going to read it from my notes here. So a standalone company, if the property is commercial, then a non-domicile will typically want to purchase through an overseas company, such as an Isle of Man company, and that's for inheritance tax planning reasons. If it's a UK domicile, then there's no advantage in using an Isle of Man company, because obviously the shares in that company form part of their estate for the purposes of inheritance tax. So if the property is residential, a UK company will typically now be used by both a domicile, a UK domicile and a non-UK domicile. And this is if it's a standalone company that's being used. That is because since 2017, April 2017, where non-UK domiciles buy UK residential property through overseas companies, they are subject to inheritance tax. So there's no real advantage. But the plot thickens if we turn to if you're holding company shares through some form of wrapper, and this will typically be a trust if the settler is non-dom. If it's a UK dom, then it's a pension, but also in typically a QNUT where it's residential property. But more recently, non-doms have also been using pension planning as well for residential property planning. So here, I think if you've got some form of overseas trust or overseas pension on top, using an overseas company is to be preferred. The reason for this is that when you pay a dividend from a UK company to an overseas trust or an overseas pension trust, if there's any UK resident beneficiaries, then you'll get you'll get tax in the UK of 38.1% on that dividend. And there's a trap that we often see with pensions, QNUPs and QROPs. If it's a QROPs, then they can only hold commercial property. Where there's a UK company that's held below the overseas pension, and there's either a UK resident member or UK resident beneficiaries that benefit on death. And that's sufficient for this 38% charge to apply on the dividends. It only doesn't apply if all of the beneficiaries are non-resident, which is quite unusual. The other thing you see is that sometimes beneficiaries are not resident when you start off the structure, and then they become resident when the dividend is paid, and you get this tax. So as a general rule of thumb, if you've got a wrapper on top, trust or overseas pension, still better, I would say, to use a overseas company compared to a UK company.
Yep.
So okay. I think that covers that one.
And back onto illustrations, ladies and gents, and again, thank you for such a high turnout today. This is family trust number 4, illustration number 4. The applicability, again, non-UK domiciled person, because the settlor is non-UK domiciled, which is why trusts are so important and advantageous to those type of people. The asset in this case is a buy-to-let residential property or a residential buy-to-let investment portfolio, where the combined purchase price may be substantial, but this can be enhanced because mortgage finance of at least 65% loan to purchase can be acquired, because in this actual case it's not the trust that is buying the property, it's the overseas company, and we tend to use overseas companies, Gibraltar sometimes, definitely Guernsey for those Guernsey visitors attending the webinar, and Isle of Man is also a default option as well. The objective of this investment is to have tax control, which is why there is a company owning the property and not a trust directly owning the property. Income generation, hopefully to satisfy the mortgage commitments, and a bit better than that. Clearly capital growth, because the investors are knowledgeable of where they're buying, to make sure that capital growth is sustained, and inheritance tax relief, mitigation and legal avoidance. In this situation, ladies and gentlemen, there's 5 major elements. The non-UK domiciled settlor is settling the, often with a buy-to-let investment, it is useful to have mortgage finance. So the settlor is settling a deposit, 35% or equivalent, and costs a little surplus. They're settling in, appointing sovereign trust in Guernsey, Isle of Man, etc., as the non-resident, non-UK resident regulated trustees. The third component is the spouse, children, loved ones, and like the illustration I used probably in number 2, the settlor is specifically excluded. So it's a settlor excluded trust, and the actual asset, the first asset, is not the property, it's the trustees that subscribe to the shares of an Isle of Man or Guernsey company, and that's the entity that acquires mortgage finance. A little bit less challenging to undertake than a trust, and that company is the target entity that buys the UK residential property on a buy-to-let basis, whether it's one or several, with the application of mortgage finance, sometimes on an interest-only basis. You've got mortgage rates moving up, but they can be on an interest-only basis, and we have the ability to source that. So the benefit on the left-hand side is, again, no lifetime inheritance tax going in. There's ATED exemption. You have to apply for ATED exemption, but the application criteria in this case is that the UK residential property is being rented to third parties, not the property is not being occupied by closely connected parties. So you'll always have ATED exemption. It's almost like a little business. You are renting it to third parties, generating a market rent, and therefore hopefully exceeding the mortgage interest charges. Net rental income after deduction of mortgage interest will be subject to corporation tax, currently at 19%, but we know, well, the UK parties know, unfortunately, we're being a little less competitive on the corporation tax front, ladies and gentlemen, because it's moving to 25%, unless our Prime Minister can wield his magic and have that reduced. Unlikely, but over time, our Mr. Sunak will clearly do that. So about 25% next year sounds a bit Scandinavian, doesn't it, with those tax rates? But I'm not going to get into politics at the moment. So 19% tax corporation tax rate, let's just say corporation tax rate, UK corporation tax rate on net rental income. If the property eventually is sold or a gain, it's corporation tax rates that will apply on the net gains. You still get full deductible mortgage interest, but that's against rental income. The 10-year anniversary charge applies, but in many cases the mortgage remains in place, because often it's an interest-only mortgage. So you deduct the mortgage amount from the value in the 10th year to arrive at a calculation for the 10-yearly charge. And importantly, apart from your income attributions and objectives, capital gains ambitions, no inheritance tax, ladies and gentlemen, on the demise of the settlor and beneficiaries. So that concludes half of the case studies at the moment, and we're going now, Lawrence, to family investment companies, which is a
Well,
little
we've
bit
had
of
a question.
so,
We've had a question.
we had a question.
We've had a question. I can read it out if
Yeah.
you. If I've, yeah. So the question is, in relation to illustration 3, where the child is the life tenant, is it best to get an interest-only mortgage to keep the net equity as low as possible at on the 10-year anniversary, the 20th anniversary, the 30th, and so on and so on? Or does that increase CGT? Well, the answer to that is yes, it's better to have an interest-only mortgage. The reason for that is that the debt is kept at the maximum possible
Correct.
level. Obviously, if you repay the capital as well as interest, then you're reducing the debt and you're then increasing the value of the property on the 10-year or the 20 or whatever year anniversary. It does not have any bearing on capital gains tax. Mortgages and debt don't really affect capital. They don't affect capital gains tax the way that gains are calculated. So it won't have a bearing on that. It's just when we have these cases with clients, it's just normally a sort of a question of looking at what the cost of the borrowing is compared with, well, you know, is that cost actually more than what we're going to be paying in tax on the 10-year anniversary? Sometimes, though, we have clients who don't have the capital to actually pay the property and need the mortgage out of necessity. So they have, say, a 2 million deposit, and then they need to borrow another 2 million. And in that's obviously ideal because you're getting planning of the 10-year anniversary, and you're also getting the funding that you need or the trust needs to purchase the property. And we can offer that. And one of the reasons why Isle of Man tends to be favoured for these type of structures is the relationship they have, that office have with the banks there, and are still able to get very good deals on mortgages.
Thank you, Lawrence. And now,
yep.
Family investment companies. We're doing well, but we're trying to keep the time as well.
Yep.
Thank you for your questions. Keep them coming in, ladies and gentlemen, please.
Yeah, absolutely. So with FICs, non-DOMs investing in UK property can no longer use standard overseas companies for inheritance tax planning. That point is clear, and we've already covered it. They can still use overseas companies if it's commercial property, not residential. Flexible property trusts are good for personal use, but they're no good. Well, they're generally speaking for they can be used for investments as well, as Simon was taking you through earlier on. The downside, though, of FPTs is that they have the exposure to the relevant property charges. So that is a downside. Family investment companies have no exposure to those charges because they're companies and they're not trusts. So those charges cannot apply to an FIC. So FICs, as I've just said, not subject to the relevant property regime. They allow the donor, who's the equivalent to the settlor. So with FICs, we refer to a donor. With trusts, we refer to the settlor. They're both the same in principle, which is the person who is injecting the money. They allow them to exercise control over the arrangement, and in certain instances to continue to draw down funds. And we'll come on to how they should do that in a moment. There was some concern with FICs until a couple of years ago. I think it was until around 2020, around that sort of time. That HMRC were going to look to legislate or recommend that the government legislates against them. But then we received this publication about a year ago, which was really helpful to say that HMRC regards FICs as reasonable tax planning, and they're not going to be attacking them. So that provides us with some really good comfort that we can continue to use them, and they can be utilised by non-DOMs who are investing in residential property. They rely on the principle, and of course for UK DOMs as well, I should add, but for UK DOMs, they can be used across the board for UK assets and overseas assets. They rely on the principle that interests in company shares carry 3 different rights, so income, voting, and capital. And it's a single share doesn't need to carry all of those rights, which is why you can get voting shares and income shares and all the rest of it. So they can carry one or more of those types of rights. The other key principle that we rely upon here is that once the donor has injected his cash in or her cash in exchange for shares, they're then in a position to gift some of the shares to normally children, or it could be grandchildren, and those are potentially exempt transfers, so pets. Contrast the position where you've got UK domiciles, and they're setting up trusts. Well, all transfers to trusts are now immediately chargeable transfers and subject to lifetime IHT over and above the nil rate band. So with FICs, there's no limit to what you can gift. With pets, there's no ceiling on the value. We'll see whether that actually continues. That could be one of the areas the government look to attack, because obviously they're going to be looking at everything. They need the money. But at the moment, the position is with PETs that you can gift what you like, unlimited value, provided that you survive 7 years, provided you don't reserve a benefit in the property that you've given away. And the final point is that with shares that are split between the family, you're diluting the value of the whole. So to give you an example, if the donor puts in 2 million into the company and then splits it into 5, so each of the shareholders hold 20%, you're going to find that 20%, the value of the 20% shareholding is not going to be 400,000, which would be 20% of the value of the company. It's going to be a lot less, because you get that discount for actually to reflect the fact that it's just a 20% shareholding in a company. So that's the other good thing about FICs. So they rely on all of these principles, really.
Okay, thanks, Lawrence. I will move on to illustration 5, and we'll have a question. We'll deal with the question after this illustration.
Yeah. Okay.
And there's my notes, here we are. And the applicability here, in this case, it's UK DOMs and non-UK DOMs, as well as UK residents and non-UK residents, so a bit more open applicability. The asset is a buy-to-let investment property or investment property portfolio, perhaps in a variance of this case study, actually. And the objectives, again, similar to my buy-to-let illustration, a bit of income growth, capital gains over a long-term period, and the planning for inheritance tax, which Lawrence nicely described in the previous slide. But here we are. We've got the donor, in this case, is a non-resident, non-domiciled person, benefiting from a weak pound, and able to invest in the property industry for the long term, which always gives remarkable gains. He subscribes, or she subscribes, for shares in a UK family investment company. So the donor is actually contributing £3 million in share capital to their UK company and 2 million in loan capital, because they would like to have the ability to recover that loan on an interest-only basis, Mr. S. But that's the questioner, or the person posing the question. Thank you, Mr. S. I won't mention your name, but thank you for contributing.
We'll come on to that question in a minute. So
yes, let's answer that question in a minute. We do know that the gentleman is grateful for his question. And 5 million, therefore, is contributed into the UK company by way of share capital and loan. But from the very, very outset, the donor is the registered shareholder of both share classes, the A shares, that's voting shares, B shares, that's the capital and income shares. And in the situation in half answering the question, the loan is an interest-free, payable on demand loan. So that person can recover that loan on demand. That's step 1. Step 2, shortly thereafter, the donor, with the advice provided independent of Sovereign, because we're delivering what you see, gifts all B shares, that's the capital and income shares, to the children. And if they're very young, we can hold them under a classic nominee declaration of trust made in their favour. And he's also, she or he, is gifting 30% of the voting shares. So the donor, most of our clients being relatively young, is surviving 7 years, not a problem, and should only be subject to inheritance tax eventually on their demise, way after 7 years, God willing, on the value of the voting shares retained. And if the and if the value of those shares falls under the nil rate band, whenever that nil rate band decides to increase, not for a while, I might add, then the inheritance tax exercise has been effectively completed. We've got to look out for gifts with reservation of benefits, GROB, carve-out planning needed, pre-owned asset tax, and ATED. So in this case, for ATED, the property portfolio or very nice single rental property is not being rented to closely connected family, and settlement legislation, which Lawrence will cover in the question, can HMRC argue that the repayment of the loan by the FIC, the UK company, is taxable under the transactions in securities rule? Thank you, Mr. S. Drafting of the articles, of course, is absolutely fundamentally important, which again we deliver. So step one, step two, there's the solutions. There's lots of notes that we can share with you on this and all of the arrangements, but I'll let Lawrence, who's going to be delivering the next slide in part 3, to nicely continue with that answer. Rather you than me, Lawrence, over to you.
Yeah, good question. We've obviously referenced the various bits of anti-avoidance legislation that can apply. I think that it's important to bear in mind whether the donor is resident or non-resident, because some of this legislation won't apply if they're non-resident, for example, the pre-owned asset tax. I think with the pre-owned asset tax, though, here it's going to be straightforward, because as long as it's a third party that you're, well, anyone in fact that you're renting it to, then the donor's not going to have any use of the property, so that won't apply. And equally, ATED won't apply because the third party letting. Simon's already dealt with GROB, and the point there is it's a carve out. So then that takes us to transactions in securities, and it's a very good question. There has been concern raised with the widening of these transaction in security rules to cover liquidations recently, as to whether a loan could trigger the application of these rules. I think there would be problems for HMRC here if they were to invoke the transaction in security rules in this example, and in the planning that we recommend with FICs, which is always to keep it simple. And I think there's two reasons that you could raise here to say that they don't apply. The first is that I think under the legislation, I'm not going to go through it now in detail, but it does have a condition that there's an income tax advantage. And you would say here, or a corporation tax advantage, you would say here that there isn't one, because what you're doing is loaning the capital in as a substitute for share capital. So obviously with share capital, when you put it in, it's hard to get the money back out, because you normally have to liquidate the company, and HMRC don't like, share buybacks and all of that sort of stuff. So the loan itself is used as a form of accessing the capital that's gone in, but you can't say that it's a substitute for a dividend, because what you're getting back is the capital that you've put in. And if the company was going to be liquidated, then you'd get back your share capital. So all the loan is doing is allowing you to access your capital back more easily. It's not tax avoidance. And the second point I would say is that it's not artificial either. Loans have been used since the dawn of time with this type of thing to capitalize companies. It's very, very common for people who are setting up companies to loan the capital in, as well as to put some in as share capital. The third point would be there's a nice even balance here of loan and share cap. So although this is normally something that comes up with the thin capitalization rules as to what's your debt to equity ratio, but here you've got more equity than debt, 3 million share cap, 2 million loan. So that's very reasonable too. So I would say for those three reasons, this should be fine, this model for transaction in security purposes and for the other anti-avoidance legislation that we've referenced. But because of this anti-avoidance legislation, we do insist on getting external tax counsel advice on these FICs, particularly when it's an FIC such as this, involving residential property. And they will obviously provide the tax advice on these points, but we would instruct them for you, so you can be clear on the likely outcome of the tax opinion.
Okay,
So hopefully that answers.
thank you, Lawrence. Thank you. I've just sent you a little note. We're only on part 3 of 5, but these parts now go relatively quickly. And Lawrence, it's over to QNUPs, qualifying non-UK pension schemes now, please.
Yeah, okay, so I'll just go through these super quickly. This is more of a reference slide for you to have for your own benefit, the statutory provisions which set out the exemptions from which QNUPs benefit. I'm not going to read out the legislation, it's just there for you to see. There's 3 key exemptions. The first one is from inheritance tax. So on the member's death, they should the value of the fund that's remaining on their death should not form part of their estate with care. Care is needed though with this. Secondly, QNUPs are exempt from the relevant property regime, so there's no 10-year charges and no exit charges. Exit charges can cause a real problem with pension planning because you're always making distributions out of lump sums and income. And then thirdly, there's an exemption from capital gains tax where the QNUPs sells the property directly, where the property is held directly in the QNUPs and the sale is made by the QNUPs. That exemption does not apply if there's an underlying company below the QNUPs. And then, as we've just referenced there, they're also outside of ATED, but all trusts are outside of ATED, including obviously QNUPs. So there's also finally been a recent decision of the Supreme Court which has confirmed that one of the key exemptions to ensure that there's no lifetime IHT charge on contributions or transfers to pensions does apply, and that's section 10 in the pension context. So that gives us some comfort as well in this area. It was a good decision, even though the taxpayer actually lost. It was good in that sense. So that's, I think, enough on that slide, and we can move back on to illustrations.
Case study, I think that's the right one. Thank you, Lawrence.
Yeah,
and that useful summary always sets the scene for a case study. The applicability for QNUPs, our preference is Guernsey QNUPs. They apply to both UK domiciles persons and non-UK domicile persons, and Parliament legislated for QNUPs back in 2010. So 22 years of experience of Sovereign and the industry having experience in deploying QNUPs for a wide variety of diversified investments. So the asset here is buy to let. I wouldn't use a QNUPs for a main residence or lifestyle type of purchase, because a pension should basically be structured to derive an income for future retirement. And then you would perhaps not have the primary residence relief built in. It'd be too complicated. The asset, a buy-to-let investment portfolio, the objective is for capital gains planning. Inheritance tax planning is a little bit down the list, and UK pensions, classic UK pensions, are perhaps not relevant and not permitted to buy UK real estate directly, whereas QNUPs can. And we've illustrated here that 70% of the QNUPs fund can be directed towards not an unusual asset, but a different asset, being an investment UK property portfolio. With a QNUPs also, it's not tested against the lifetime allowance and the annual allowance that are somewhat restrictive towards UK pension planning. So there's a variety of different objectives that this client and family would like to undertake by successfully deploying a QNUPs. And the generally works that there's a cash contribution going in to the QNUPs, who effectively is the member of the pension scheme, who can be UK resident, non-UK resident, UK domicile, non-UK domicile. And the attributes of this planning is that sovereign trustees in Guernsey are the QNUPs pension trustees. The member, or the person contributing the cash into the bank account of the trustee, becomes the member of that qualifying non-UK pension scheme, and rather like a trust, he or she elects who are to be the beneficiaries along with a tidy set of wishes as to what should happen come an untimely demise and how succession should be dealt with. There's an element of traditional investments enjoyed within the QNUPs, cash, liquidity, movable assets, traditional pension assets, with 70% assigned with the trustees to invest directly into UK investment property. And the summary of these attributes are on the left-hand side of your screen. There shouldn't be any entry charge, so no lifetime inheritance tax at 20%. And you know, these arrangements are dealt with on a case-by-case basis. SDLT will apply with the surcharges. The drawback on this, ladies and gentlemen, is net rental income, even after deduction of any mortgage interest, is taxed at 45%. So maybe income planning is immediately not the objective of the member. But if the trustees of the pension scheme actually sell some of the property assets, don't forget you've got 30% of the fund held within a movable and traditional pension environment in terms of investments, the gains on sales, when a gain is made, not subject to capital gains tax. So there's an articulate benefit on that. And more importantly, or just as important, going down the list of benefits, no inheritance tax on death of the member. So useful attributes there, and that certainly sets the scene on capital gains and inheritance tax planning. And we now move on to Lawrence, who's going to finish this section with a variation, illustration 7, Lawrence.
We've had another question, but I'd say if we leave the questions now to the end so we can finish on time.
Yeah, good idea. Yeah.
Okay. So in terms of this, I'm going to be quick here because it's the same structure except that we're using an underlying company below the QNUPs. So the tax advantages are essentially the same, but there's one key difference with this. The downside of using this structure is that the company will be subject to corporation tax in the UK on the capital gain that's realised. The benefit of this is that you're going to get corporation tax on the rental income rather than the trust rate which you get with direct QNUPs ownership. So with direct QNUPs ownership, the rate is 45%. With the underlying company below the QNUPs, the rate is currently 19%, but it's going to go up to 25%. So it is difficult, but you have to then factor in the additional cost of running the structure with a company. You know, with a property owning company, it's at least £5,000 a year to run. And then you've really got to do the maths in terms of how much are you going to be saving by using a company. The other point is that if the member is looking to transfer an existing property into a QNUPs and the transfer is going to have capital gains tax issues, you'll need to check that point. But in relation to stamp duty, if there's no mortgage on the property and you move it into a direct QNUPs ownership, there's no stamp duty. Whereas if you move it into an underlying company, there is stamp duty. So you've got all these variables that you need to go through to work out what's the most efficient structure. What I would say on balance is that because corporation tax is going up to 25%, we think the likelihood is that direct QNUPs ownership is going to be preferred because of the capital gains tax exemption. However, you may say, well, our UK property is going to be going up anytime soon with market conditions. So it's very much the case of just going through all of the different taxes and coming to an informed decision with tax advice. But these are the two solutions laid out for you. So case by case, and obviously you've just got to check the client's objectives as well. But these are the two structures you can consider for property investment using QNUPs.
Thank you, Lawrence. We lost you for about 5 seconds there, but you're back on, and we'll take that question at the end. Are you okay to go on to part 4, Lawrence? Good.
Yep, that's fine.
So part 4, ladies and gentlemen, and the last of the illustrations. So we're closing in really, and thank you for your undivided attention. The previous questioner Mr. S, thank you for your comments. And Jennifer will answer your question in a minute. This is one of my favourites. It's part 4. It's UK commercial property. Applicability again, non-UK domiciled persons, but can really apply to UK domiciled, especially on the wrapper planning by having a QNUPS parked on top in the shareholder space in the illustration there. So multiple applicability. It's the asset is a UK commercial property, not a residential dwelling, a hotel, an office, a commercial building, a conversion to something commercial, a warehouse, you know what I mean. The objective, well, with commercial property, you've got much less stamp duty, land tax, obligations and liabilities. Income and capital gains tax will be charged at corporation tax levels, but you've got substantial and natural inheritance tax benefits to enjoy as well. And in this case, the Isle of Man is favourite because for VAT purposes, Isle of Man is technically indistinguishable to a UK VAT registered company. So we can, as we're online in the Isle of Man, we can get a company incorporated quickly, and through the Treasury in the Isle of Man, with a push and a cup of tea, you can actually get a VAT registration done or materialised within weeks, whereas that's not so certain in the UK. So for VAT purposes, VAT registration, transfer of going concern applications, an Isle of Man company purchases a commercial property as a transfer from going concern from the vendor, who may be a VAT registered entity, or the building may be VAT elected. So there should not be any VAT on the purchase being made, which is fundamentally important to have that certainty in place. There's no surcharges on this asset because it's a commercial asset, not a residential property asset. And the maximum applicable stamp duty, which we hope the Prime Minister and the Chancellor does not meddle with, is at the moment 5%. The government welcomes the high levels of foreign direct investment that's coming into the UK for the acquisition of commercial property. Long may that continue. It's not a residential dwelling, so there's no ATED. Because of the complicated laws governing residential property, there's no 10-yearly anniversary charge. And so that's another benefit. And in this situation, even how it's structured with Sovereign delivering the management and the shares being held at the moment by the individual shareholder who's non-UK domiciled, no UK inheritance tax. Net rental income and net gains upon a sale being eventually materialised will be subject to corporation tax. And you've got the indirect disposals application, the rebasing, but compelling reasons why you would structure arrangements like this. We do a lot of this in the Northwest, in the Midlands, where perhaps commercial property acquisitions are a little more vibrant compared to the residential commodity mix of Southeast England. Again, for extra planning, a non-UK DOM may be wise to organise for their ownership to be held within a trust, and a UK DOM could always use a QNUPS. So we will canter on a little bit, and we'll go on to the last part, Lawrence, which is the new part, but nonetheless rather important. And we have had seminars and webinars on this lasting for an hour or two. We're not going to put you through that, ladies and gentlemen. This will take a couple of minutes, and the presentation will be sent to you, and so therefore you can use these slides as useful reference. Lawrence.
Yeah, and there is a reference slide that goes through the application of the ROE and TRS to all of the illustrations that we've covered today. If anyone has any questions on that, if they just want to drop me an email, I can answer those separately. We just didn't think there was time today to be going through it all, but the answers are all there. So to start off with ROE, on the 15th of March 2022, the Economic Crime Transparency and Enforcement Act, quite a mouthful, came into effect. We're just going to refer to it as the Act, out of which the Register of Overseas Entities was born. The ROE, the register, opened on the 1st of August 2022, and it's available, or it will be available to the public. It will mean that details of all overseas companies that own any type of UK property will need to go on that register, and they will need to they will need to disclose the details of their beneficial owners. In some cases, there won't be a beneficial owner to disclose. We're not really going to be going into that of any detail today on that. The important point to note is that deadline for registration by the company that owns the property is the 31st of January 2023. Finally, HMRC will have privileged access to the register, so the general public will not be able to see the information that will need to go on trusts, where a trust is the beneficial owner of the company. But HMRC will be able to see that, and they have made clear that they're going to be going through the register with a fine-tooth comb, and potentially there'll be inquiries. So it's just very important, if you've got clients that are going on this register, or companies with beneficial owners, that you make sure all the tax advice is up to date on this in the event of a HMRC inquiry. Sovereign do deliver our ROE requirements, and we have already been servicing overseas companies, so we're already making these disclosures at the moment, and we have been actually for a couple of months. So I think we can just move. I can just quickly run through this slide, I think, Simon, on the ownership conditions.
Just a second. Martin just emailed in, and thank you, Martin. With regards to register overseas entities, is it necessary to register properties? No, held by the companies, or just the actual overseas entity? The answer is yes to that. And as we've mentioned at the bottom of this slide, Sovereign delivers registration of overseas entities with Companies House. We're a member of Companies House portal for this purpose, and we've already been of service to a volume of overseas corporate. We have a 2-page information sheet and a neat user-friendly application form. So once we receive that, it takes, once the compliance is sorted, once we've got all the materials, it takes the best part of not a day, but it's, as we've done a volume of these, it's not an inconsequential service exercise, but it's probably done within an hour or so once we have all of that information. Anything else to add on that, Lawrence?
No, I think that was completely correct in terms of the registration of it's the company that owns the property that registers, and it obviously provides the details on the property, and its beneficial owners, if there are beneficial owners, to disclose. And
I'm going to canter you through the tests, Lawrence, if I may,
Yep.
which again is a reference slide. An individual legal entity will be the beneficial owner of the property holding entity, which registers on the Register of Overseas Entities. If they meet one or more, ladies and gentlemen, the following conditions: more than 25% of the shares, more than 25% of the voting rights in the overseas entity which holds the property, or they hold the right directly or indirectly to remove the majority of the board of directors control, in essence, or they have right to exercise significant influence or control over the entity. So it's pretty all-encompassing. Tests 1 and 2 can be met either by the beneficial owner holding the shares in their own right or through a nominee. And if one of these tests are not met, the person is a beneficial owner. They will have a registrable beneficial owner unless exempt. And we deliver this service. It may look complicated, but as we've done, and it was very complicated when we started to register companies, overseas companies, with the authorities, but having done loads now, it's become a pattern to the madness and the science. So come to us, we can sort this out. Next slide, trust registration service, Lawrence.
Yeah, so this has been with us for a bit longer. So it came in with the but it was introduced by the regulations that you can see there. TRS is effective from the 2016-2017 tax year. With TRS, you're basically looking at two conditions which need to be met for an overseas trust to register on TRS. Remember that it applies to overseas discretionary trusts, interest in possession trusts, pension trusts, if these two conditions are met. The first is, does the non-UK trust hold UK assets or have UK income? If no, then it's outside the scope of TRS. It cannot apply. If it does have either UK assets or UK income, then you need to check the next condition, whether the next condition is met. Has there been a tax trigger event in relation to income tax, capital gains tax, stamp duty, land tax, inheritance tax? There's a few other taxes, more obscure ones. They're the main ones. If there has been a trigger event that's occurred since the 6th of April 2016, then the trustee will need to register on TRS. But if the tax trigger event occurred before the 6th of April 2016, there won't need to be there's no need to register until there's a tax trigger event. So if you've got, say, an overseas trust that holds UK company shares, UK resident beneficiaries of the trust, but there's been no dividend paid since the 6th of April 2016, let's just say, there won't, and no other income that's caused a tax liability for the trust, then you won't need to register. The trust won't need to register until there's a dividend payment, which would trigger the need to register. And interestingly, the test is whether there's a tax liability. So if it's an overseas trust and there's no UK resident beneficiaries, then there shouldn't be a need to register because the dividend would be exempt from tax. There would be no liability. Note that the special rule that applies for land, this has received a lot of coverage, that effectively if the trust has acquired a UK property of any description since on or after the 6th of October 2020, then there will be an automatic need to register even if there's been no tax liability triggered by that property. In most cases, when you buy a property through trust, there'll be stamp duty. Sometimes there isn't if it's a gift, but that's the position with direct property ownership. That rule only applies to acquisitions on or after that date, and that's quite important because there's often trusts that have been set up before then. They still do not need to register until a tax liability arises for the trustee. That's TRS in a nutshell. So we can now hop over to the, sorry,
Yep.
Do you want to add something?
Don't forget, we don't outsource and late outsourcing on these register overseas entities and TRS trust registration service. Sovereign own 8 trust companies. I mentioned Gibraltar, Guernsey and the Isle of Man before. We have 8 trust companies wholly owned by our group, regulated to provide services, which is no mean feat to acquire a license. And Sovereign's trustee companies, each and every one of them that provide client trustee services, continue in-house, no outsourcing, to address TRS registration, ROE and ongoing compliance, rather than let the settlor worry about that. Well, they can worry about it, but we deliver that service. We've had about 10 minutes of questions, and we're going to canter through this one. We've got a couple of slides left. If you look back, ladies and gentlemen, relevant to dealing with the application of register of overseas entities and trust registration service, left-hand side, you've got 8 illustrations. You're going to get the deck sent to you by email. I'm not telling you what to do, but if you print it out and then you can have a look at the illustrations. And with this slide, the reference slide, you'll then need to know whether the illustration or the case study needed to be registered for TRS, register of overseas entities, both, one of them, none of them. And we also we can have a look at the significant persons, beneficial ownership registers, and that sort of thing. Again, we deliver all the compliance, but every 8 illustrations, case studies that we've referenced in the presentation is on point with the TRS and ROE mentioned in this slide. Are you okay with that, Lawrence?
Yeah, and we can go on now to the illustrations to show you potentially how you can structure an arrangement so that it doesn't fall within either TRS or ROE. Now, we're not saying here, just to be crystal clear, that this is a way of avoiding those registers. There's always going to be the case now that with tax planning, there will need to be disclosure of some description for sure. It may be, though, that you get clients who just don't like the idea of going on those specific registers because of the publicity that they've attracted. It does put clients off. So for new acquisitions, this is something that they could consider, these two illustrations, which still, where you still get all of the tax benefits of the structures that we were looking at earlier, but you wouldn't need to go on the ROE or the TRS. Well, why is that? The reason is that you're using a UK company to acquire the property through. UK companies are outside the scope of the Register of Overseas Entities. It specifically says in the first page of the legislation that it only applies to an overseas entity. So it cannot apply to UK companies. So what you can do is acquire the property through a UK company. Now, with this first example, we're looking at commercial property. And for this reason, the trust structure that we're looking at, it still falls within the definition of an excluded property trust, despite the fact that we're owning it through a UK company. Well, how is that? How would you do that? Well, you start off again setting up an overseas trust into which a non-UK dom will contribute funds, the settlement. The trust then subscribes for shares, in this instance in an Isle of Man co. The funds could be loaned to that co, or they could go in as share capital, or a combination of both. Same with the UK company. And then the UK company acquires the commercial property. Well, in this instance, the settler can be a beneficiary of the trust. There's still no inheritance tax on his death because it's an excluded property trust. The reason for that is that the assets of the trust are the Isle of Man company shares, not the UK property or the UK company shares. It's essential to have that Isle of Man company there, or an overseas company, because if the UK company were held directly in the trust, then you'd have relevant property charges and inheritance tax as well if the settler is a beneficiary. So at the bottom level, you've got corporation tax, as we've discussed. The good thing is that there's no real difference now between overseas codes and UK codes. They're both subject to corporation tax on income and gains. But the key difference here is that in terms of the registers, you fall within the PSC, the person with significant control. So you still fall within a register, it's just more benign. And the UK company registers on the PSC, but you won't actually have to disclose the details of the settler and the beneficiaries, etc., provided that no one's exercising influence and control over normally the property owning company. And that's likely to be the case. So as long as provided that is the case, then you won't have to register any of the beneficial owners on this register, which could be helpful. And then we've just said there at the end that with this type of structure, if the UK company shares were sold, then the stamp duty would be limited to 0.5% rather than standard stamp duty, because it's stamp duty reserve tax that applies there. So now Simon's going to take you through the final illustration.
Yeah, it is the last slide. Yes, the last real illustrative slide, and then we'll send these notes out to you. There is one question, which is a very good question, Kevin. Thank you. Do you deal with UK anti-money laundering rules before onboarding clients? Yes, for all of the non-UK and UK DOMs that use structures to effectively acquire underlying real property assets, because of the complex nature of this structuring, we do actually acquire UK independent tax advice, independent of sovereign. Yes, we know what works and what we should do and what we shouldn't do, what the safeguards are, cantering the client through what what works these days as opposed to what doesn't. And yes, we are familiar with GAR, TAR, DOTAS and the anti-avoidance provisions, and the tax advice will contain those attributes and will ensure that the tax advice delivers positively, because what's the point in putting a structure in place if it doesn't work? So yes, that's a positive, Kevin, and I hope that answers that question. We've had about 15 minutes of questions, that's why we're a little overrunning, but thank you. And we've got one more question to go, and I'll let Lawrence answer that. But you've got the illustration on this one, the last illustration on the right side. The top item falls within the PSC register, but in this case, the settlor and the beneficiaries, who are not influencing the trustees at all, because that might be a sham, are not featured on the person with significant control register, therefore keeping the client without not needing to appear, and therefore enjoying the relevant privacy that they so well deserve. It's not within the scope of ROE, not within the scope of TRS. We could use here a Gibraltar, Guernsey, Isle of Man company. I wouldn't use anything else, because there may be mortgage finance situations, and that Guernsey and Isle of Man at least are members of the British Isles, and banks are familiar and friendly towards these arrangements. No inheritance tax on the settlor's death. He's excluded as a beneficiary, not deemed domiciled when the trust is established. UK capital gain, UK corporation tax on net rental income and gains, and any gain from the UK share sale by overseas company is now subject to corporation tax, property rich assets, I suppose, or property rich regime, but stamp duty for the buyer of the shares should be limited to 0.5%, ladies and gentlemen. We've still acquired most of 90% of your attention. Thanks for staying on with us. Lawrence, do you want to reflect on the question that the only question left, actually? We've had about over half a dozen. We've sort of answered a lot of questions within our illustrations. Thank you, David, for your comments. Thank you for other compliments, incidentally. And we've got to Jennifer's question, Lawrence, if you can see, for the FIC share capital. I'll let you answer that while I just go, while people can have a little look at this as well.
Yeah, and just a key point on that slide Simon was taking you through, the settler has to be excluded. That is a relevant property trust. In my example, it was an EPT. That's an RPT. We need to exclude the settler, and we do get 10-year charges on that one, but this, on the basis settlers excluded, there's no inheritance tax on there. Okay. And in both cases, you have to have a non-dom settlor who is not UK deemed domiciled. So shall I take the question now?
Yes, please. Yeah, take the Jennifer's question, if Jennifer's still
Jennifer's there. Question. Yeah, hi Jennifer. So well, the question is, for FIC's share capital, back to that issue again, and loan capital, can the ratio be 10 to 90? So I think we're saying here 10% share cap and 90% loan cap.
Correct.
Well, let's answer that first. I think in principle, yes, it's fine. There would be a niggling concern there with the transaction in securities rules with that type of ratio as to whether HMRC could invoke those. If you remember the answer that I provided earlier, one of the reasons I gave that I didn't think it should apply the TIS to transactions in securities was that there was more share capital to loan. The share capital to loan ratio was higher. There's more share cap than loan cap. In this instance, you wouldn't have that argument, would you? Because it's 10 to 90. I would still say that the other reasons would remain valid. So arguably, it should still be okay. But it's on the risk scale, it's definitely more risky doing that than having a nice even balance, which would always be our preference. Then the question goes on, can there be only one single shares with right to vote, capital and income, such as that the founder can control the voting shares by giving less shares to children at the beginning and gradually giving more shares when the children are capable of managing the company? Yeah, the problem with this is there's a couple of issues. With the FIC, it's very important for an effective carve-out arrangement that you structure it as you want to at the beginning, when the shareholder, who is the founder, puts all of their capital in and receives all of the shares. And what we're relying on is this principle in the Ingram decision, where you carve up your cake at the beginning and you keep the part of the cake that is going to belong to you, and you give away the rest. And in the future, the benefits that you receive from that, or the control that you exercise, are attributable to what you carved out originally. That's the key principle. If you get into a position where you're giving away periodically over time, that then risks that principle from applying. So my preference is always to carve it all up from the beginning. Yes, it's possible, but it's more complicated. And I think you're risking your carve-out argument under reservation of benefit rules. There's going to be more of a risk there. The other issue with this, when you're making gifts over time, is that you're going to be making part disposals. So even if the founder is non-resident, because we're dealing with, in this illustration today, it's a property-owning company. So even if you structured it in the Isle of Man, the FIC, or one of the other overseas jurisdictions, when you give away the shares, they're now chargeable assets for CGT. So you'd be making a part disposal. So there would be capital gains tax implications if the value of the underlying assets, the property, had gone up. You'd be triggering CGT. So for those two reasons, I would avoid it, and just make sure that you carve everything up as it's required from the beginning. Now, one point we always get with FICs is, well, the kids are only 5 and 6, 7. They can't hold the shares at the moment. Well, they can beneficially hold them, and all you need to do is to set up a nominee to hold the shares until they're 18. And that's a service that we can provide. And probably with FIC planning, it's better to have an independent trustee as nominee, because if you act as nominee, as the founder acts as nominee, which is possible, you'll often find that you just treat those shares as your own, rather than them being beneficially owned by the child, because these concepts are quite abstract. We're obviously used to them because we manage these arrangements all the time, but if you're just doing it yourself, you could run into issues and start keeping the money and spending it when you receive a dividend, rather than holding it as bare trustee for the child. So by all means, yes, it's possible to carve everything up and make gifts to children, so you're activating the 7-year rule straight away, but we would recommend you would have to do it through a nominee to hold the shares until they're 18, and we would recommend that we would provide that nominee service rather than the founder. So hopefully that answers it.
Yeah, Lawrence, we don't want to hold people up, although we're still in triple numbers, which is testament to the patience and interest of our audience this morning. And thank you for staying on. There's 2 questions, but you're going to get the presentation, ladies and gentlemen. You're going to get the contact details of Lawrence and myself. Lawrence is a registered qualified barrister, our group tax counsel. I'm the managing director of our London office based in the UK. The slide in front of you tells you what we're about and what we've been doing over the last 35 years, almost 4 decades, extending all of those services from 23 international offices and subsidiaries wholly owned by our group, regulated to provide the services as referenced, supported by 600 management and staff. So what you've seen today and what you see there, plus a lot more that I won't bore you with, is what we do on a daily basis. That's what we deliver to our global clients, including those in the UK. And we've got, come on, where are we? I can't get to the last. There we are. You've got details of the UK team in London and Lawrence's contact details at our substantial operation and presence regulated operation in Singapore. Now, Lawrence, there's a couple of questions coming in. Thanks, Miguel, for bringing these questions so promptly. You mentioned the mortgage has to be put in place at the beginning. Yes, please, because then it'll be treated as a deductible item. There's my part of the answer. What about refinancing later in the term? And I think the mortgage later in the term has to be used for the intended property investment. That's Kevin. Kevin, thank you. Lawrence, quickly on this, please.
Yeah, so the problem with refinancing, doing equity release after the acquisition, is that in 2013 there was an anti-avoidance provision that was introduced into the IHT Act, which is section 162A, and that prevents you getting a deduction on the 10-year charge if the proceeds of the borrowing are used to acquire excluded property. So what that means is that if you've got a property that's held in trust, trustees take out a mortgage against it after it's bought, after it's been purchased, and then they deposit the loan overseas, well, that's straight away excluded property. So you won't get the deduction on the 10-year anniversary. One bit of planning you could consider, which I'm actually looking at for a client at the moment, is well, what if you bring the money into the UK? Then it's not excluded property, and I think that should be fine. We'll be going to external counsel on that. So what you would do is distribute out the as a distribution to a beneficiary the proceeds of the borrowing, and then transfer it to a UK bank account, and then they can spend the money. Obviously, if they were to pass away whilst they hold that money in the UK, then that's subject to IHT. But what you would hope is that they use it for spending, and they spend it all by the time of death, and then that would be effective. So that's something to consider. But certainly, to avoid those complications, the best advice is to purchase the property with the finance in place.
And we've got mortgage providers that undertake that service, and for offshore arrangements, typically Guernsey, Isle of Man, Gibraltar, and for trustees. And the last question, and then we must go, and it's Sabrina. Thank you, Sabrina. And hello, James. I know you're still on as well. No guesses who I'm talking about. With regards to the trust regulation service, in the event where an overseas trust has UK assets and income, yes, so in the event where an overseas trust has UK assets and income, or only one of these two, also are these assets only in reference to real property? With regards to TRS, go on, Lawrence, take this away.
Yeah, so they're alternatives, but in relation to income or assets. But I mean, I've thought about this, and it's hard to have a situation where you could have UK income without having a UK asset, but they are alternatives. So it's either a UK asset or a UK income. But if you're going to have UK income, you're almost certainly going to have a UK asset, because where's the income coming from if you don't have an asset? But that's the first point. So it's either income or an asset, but it has to be in the UK. The second point's a really good point, and the first one was too. But TRS is wider in this respect than the ROE, because it applies to any UK asset. It's not limited to UK property. Where we've seen cases where trustees have come unstuck on TRS, things like loans where you've got a UK resident borrower and there's interest on that loan, that's UK asset because the borrower, the debtor, is UK resident. UK income, when the interest is paid, trigger event for TRS, both conditions are met. Trustee needs to register on TRS when the interest is paid. That can be missed. Also, not just UK property, shares in UK companies. They don't have to own UK property. Any UK company share is a UK asset. Once a dividend is paid, then that's going to be a trigger event, unless, as I mentioned earlier, all the beneficiaries are non-UK of the trust are non-UK resident. Things like insurance policies, if the insurance company was issuing the policy was UK based, that would be a UK asset. But importantly on TRS, and this point about whether it's a UK asset or not is it can be tricky. But let's just say you've got an overseas insurance wrapper that's issued, say, by an Isle of Man insurance co, and the wrapper holds UK assets. Well, the asset there that's held in trust is the Isle of Man policy, and that would be an overseas asset, even though the policy assets themselves are invested in the UK. Equally, if you've got, say, an overseas company in the Isle of Man and Guernsey, and the shares are held in trust, and then that company invests in UK assets, the asset of the trust is the shares, and that's non-UK situs. And very interestingly, if the company buys UK residential property, then although the trust is caught now by inheritance tax because it's seen through, for TRS purposes it isn't, and this point is confirmed by HMRC. So that means that in that instance you wouldn't have to register on TRS, because the asset of the trust for TRS purposes is the shares in the overseas company, and there's no see-through provision. As I say, that point is covered by HMRC. There are quite sort of technical intricacies to ROE and TRS. I think the general approach should be to take a conservative approach with them and to disclose if you're not too sure. But it is helpful that when HMRC confirm these technical points, you can obviously certainly rely on their guidance.
Okay, thank you. And again, ladies and gentlemen, if there's additional questions, we are out of time now.
Yeah.
And losing a few of the audience. Thank you for staying on. We've had over a half an hour of questions. The presentation is going to be sent to you in the next few days. The recording link, the link to recording is also going to be part of the email. You've got a bit about Sovereign there, and you've got the contact details of Lawrence, myself, and my team. So looking forward to staying in contact with you. Thank you again for all of your questions. Thank you for your undivided attention, your high turnout for this delightful event. Promise the next year we'll do a webinar and a live in attendance event as well. Miguel, thank you. Team Sovereign, thank you again. Great to see you all, and thank you again. Have a very good day, and I wish you well. It's not too early. Happy Christmas. All the best. Bye-bye.
Thanks. Thank you.